Lunch, grab a drink, and take a seat. We'll get started here just to be prompt. It is noon. We have a great crowd here today, and actually we have about an equal size crowd online because we post these things live stream on Zoom, and so we have a good audience joining us online too. Just a few quick questions for those of you online. If you have questions, email them to caleb.pearson@Compass Iowa. It's right on your screen right there, or you can text them to that number. My name is Guy Lehman. I am an owner and advisor here at Compass Financial, and we're a registered investment advisor and wealth management firm. Thank you for coming. Appreciate everybody coming today. We're going to be talking, this is our mid-year economic update, and we have Dan Holtkamp with JP Morgan here. He's going to be joining us and talking through some, well, really an economic update, a view from Main Street, and then also a view from Wall Street. So we're going to be talking about both of those things. I just want to introduce all of our employees and advisors. Michelle Bjorken, where is she? All right. Steve Connard, Justin Van Houten, Caleb Pearson is actually running our technology here today, and Alan Holstein. Admins, Julie Greer, Nancy Economist, Hannah Mason, Joe Aniger, and Cheryl Hurst. Thank you. Oh, we have our intern, Brody, raise your hand. All right. He's heading back to Iowa State for his last semester. Thank you. To talk about what we have coming up next for next month's, for the remainder of the year for our in-person events. In September next month, we are going to talk and invite people in to talk about the top 5 things you need to know about long-term care, in-home care, elder law, picking the right facility, hospice. Okay, so those, it's all kind of wrapped up into one, and what it really has to do with navigating the last years of healthcare, really, between, it might be for yourself, it might be for parents or loved ones, but really understanding what people who work in those fields say are the most important things that you need to know. So please join us next month. That's September. October, we have our annual Medicare educational event. And then November, we're going to do a bit of a potpourri about dealing with the technology that we use here at Compass with our clients. And so that it would be account view, or seeing your accounts online, how to turn the paperwork flow off. Sometimes we hear that's a big request from a lot of people. How to read your statements. We're going to talk about how to open secure emails, how to work with our scheduling system. What else? There's a few other e-sign requests and secure emails. So, and also what we're going to do is we have been using a note taker in our meetings, and some of you have been familiar with that if you've been in recently. I am going to start that note taker, and it's going to take notes on our event next week. So you guys get to see how it works, and we'll look at the output when we're done with that meeting to see if there's anything, well, just to show you how it works. That's the big deal. Okay, today I'm welcoming Dan Holtkamp with JP Morgan. And Dan has been a long time friend and confidant in Compass Financial, and leading and guiding us and giving us good information to make decisions with. So Dan's going to talk about the current state of the economy, both from Main Street to Wall Street. Thanks, Dan.
Great. Thank you, Guy. Great to see everybody. I see some familiar faces in the room here today. And again, I want to thank all of you for taking time over lunch, avoiding the hot humidity of the State Fair today, and enjoying a cold lunch sandwich. So thank you for taking time. And again, thank you for Compass for having me in today. I've had the pleasure at JP Morgan working with the Compass team for nearly 15 years now. And I think one of the reasons we've had such a strong partnership over the years is we try to lead with insights. I'm not going to stand up here today and try to predict what's going to happen to the markets in the second half of the year, if the Fed's going to cut rates, where the market's going to go up, down, or sideways. But my goal over the next maybe 25 minutes is to share some perspective. Hopefully have you learn one or maybe 2 things around what's happening in the economy and how it's affecting your portfolio. To do that, I'm going to touch on a few of our handful of slides from our guide to the markets. Let's see here. I think the slides might be, you know what, we'll make this work. If I can get to the one I was going to start. I'm going to kind of bounce around here a little bit. So let's see. All right, so let's start with kind of where we've been this year. So 2025, if we flash back to the beginning of January, everybody was optimistic. The market had a nice run at the end of last year. People were excited around tax cuts and deregulation. And then really three things happened at the beginning of the year that kind of shook the markets. The first one was a company out of China called DeepSeek. Does anybody remember what DeepSeek was about or what DeepSeek does? Anybody know that? Exactly. DeepSeek is an AI company out of China, and really where the US has had dominance and has driven our markets higher over the last couple of years, for a lot less money and a lot less with technology, kind of shocked the world that maybe they're catching up to where the US is in the dominance around AI. And that brought the market down, especially some of the magnificent growth stocks. And then we had concerns around the economy was going to slow. And then, of course, in early April, Liberation Day, with the unexpected level of tariffs. And that caused the market to go from all-time high down to around 20% in a relatively short amount of time. But fast forward from where we were on April 9th to today, the market is once again back to all-time highs. The tariffs, we've not gotten a full resolution, but negotiated down and still a lot of uncertainty. Despite what some of the so-called experts have said, the economy is not in a recession. And whilst growth is slowing, the broader economy is in still pretty good shape today. And while there is threats and competitors around the world of not just technology companies or AI companies, the fact is American companies are still generating news, record profits, and are seen as some of the best around the world. And I show this slide to show, well, the last 2 years, these colored boxes are the green boxes are the S&P 500. You can see the S&P 500, recognized as the top 500 companies in the United States, were up 25% back-to-back years. Chances are, if you pulled out your statement, maybe you weren't up 25% over the last 2 years. And that's because Compass doesn't have you as concentrated and all in just the S&P 500. You might have heard in a client review meeting that they said you were diversified. The challenge is the last 2 years, those diversified portfolios, the white boxes, were nowhere near what the so-called broader market did. But fast forward this year, with the uncertainty around the economy and AI and tariffs, for the first time in a while, diversified portfolios are having a great year, led by things like international. Maybe contrary to the expected, given the fear around tariffs and what's happening with the administration going after countries, actually international markets are having one of their best years in a decade. Emerging markets are having a good year. And earlier this year, fixed income, when stocks were at their worst, were at their best. And so putting that all together, while the last couple of years has been challenging for diversified investors, the stock market's back to all-time highs, and many balanced portfolios are doing as well, up nearly 10% so far this year. And so despite all the challenges, it's been a great start to the year. But again, we know it's not just January 1st to today. It's been a roller coaster over the last 7 and a half, almost 8.5 months now. The point here is over time, this is kind of like the way Guy likes to play golf, right down the middle of the fairway. You can see that asset allocation, it's not that exciting. It's never at the top, but most importantly, it's never at the bottom. And by not panicking and getting out back in April like some end investors did, hopefully all of you have been able to stick to the plan, stay the course, and as a result of that, are back to all-time highs. So I want to flip to a little bit about what's happening in the economy and kind of why is the market at all-time highs. And it really comes down to the economy. Slides are a little bit out of order, but we're going to make it work. So if you look at the economy today, in the second quarter, the US economy grew at about 3% this year. But in the first quarter, it was slightly negative. And so that was the fear that, hey, we're headed for recession, tariffs are going to make it worse. But really what happened was in the first quarter, this big purple bar was the extra amount of imports the US brought in as companies were getting ahead of the potential for increased tariffs. And when we don't make those goods and services here in the United States, that doesn't help our economy, it helps other countries' economy. But fast forward to the second quarter, it was a big bounce back. And so when you put the two quarters together, the US is growing at around roughly 1.5% to 2%, which isn't the 3% that we saw coming out of COVID, but 2% is still the growth rate, especially when you put into the picture that the US is the largest economy in the world. And that's really mainly driven by the US consumer. The US consumer is 70% of GDP. And while there's some parts of the consumer that are struggling, especially low-income consumers, the top half of Americans are actually doing pretty well due to the fact that stock prices and financial assets are at all-time highs, home prices are at all-time highs, and while the cumulative effects of inflation are putting pressure on really every American, it's really the top half of Americans that really do most of the consumer spending. And that's why I think it's important that despite some of the news headlines we read or we see of some Americans struggling, I often get the question, how can the stock market be at all-time highs? It's because the broader economy on an average level is doing actually pretty good today. All right. One reason the economy is doing well and Americans are doing well is because actually they have jobs. Unemployment, while we've seen a little bit of a tick up in the unemployment rate today, if you look at the gray bar going back over the last 50 years, we used to show recessions, but it's pretty clear to see when there's a recession. It's during the spikes like April of 2020 or 2008 and 2009, 01, 02, 03. If you look at where the unemployment rate is today, it's nearly 4%. And while some economists expect that unemployment rate to tick up a little bit, most Americans have a job or they have a couple part-time jobs. And I think the corporate sector is very leery, even if things due to tariffs or slower earnings. I think Americans and business owners and corporations in general have this fear that if they lay off a bunch of workers to try to save a nickel or a dime today, they remember what happened in 21 and 22, that it was hard to find workers. And so you're seeing companies say, you know what, business might be slowing, but we want to do with what we can. We don't want to make big layoffs. We try to find ways to make those workers more efficient through tools like AI, and a guy talked about their AI note-taking app that can make their business more efficient. We're seeing that across the board in companies in the United States today. Now, while we'd all love a big wage increase if we're still working, the challenge with rapidly rising wages is it eats into inflation and it eats into the profitability. And so while wages were rising a lot after the pandemic, they're still rising today above the rate of inflation. So expect a wage increase. If you're on Social Security, expect a potential Social Security increase slightly. But it's not so high that it's putting pressure on these companies. Again, that's another factor why the stock market is back to all-time highs. So again, the broader picture of the economy is the economy is growing, it's slowing, it's not stalling. Americans' financial picture is in pretty good shape, and we all have jobs. And again, that bodes well market moving forward. Now, switching gears and again, talking a little bit more about the market, if you look at where we were back in February of 2020 to where we are today, this is the last 5.5 years we've all lived through. This is like the Dragon out at Adventureland. My kids went there. I don't even know if the Dragon's still there anymore. But has anybody been to Adventureland lately? Maybe not the right target market for Adventureland. My 3 kids were just there. My sister took them. But think of this as the roller coaster at the Dragon, if it's still there. This is the roller coaster of the stock market of the last 5 years. We had the down 34% due to COVID and the kind of the locked shutdown and consumers couldn't spend, and that pushed the market down. And then we had the inflation scare of 2022 and the market was down 25%. And then earlier this year, we had the AI growth, maybe tariff fears, and the market was down 20%. But if you think about that 5-year period, from February of 2020 to today, the market is up 95% despite 3 20% pullbacks along the way. If there's a definition of a market roller coaster, it's this slide right here. The point being, though, is for all those investors that have been able to stay the course and stick to the plan and hold on as tight as they can through the help of good guidance, good education, think about how good this has been. We're at all-time highs, and actually our view at JP Morgan, while markets are high and there is uncertainty moving forward, the good news is that US companies, especially larger companies, have record levels of cash. They're seeing profit margins stay high, which I don't always love paying more for the 6 bag Doritos at Hy-Vee. But if you're an owner of PepsiCo, that's a good thing that that price has gone up and yet we still buy those Doritos for the kids. Or the bag of, or the tube of toothpaste that you always used to have to go buy the specialty toothpaste when you travel to stay under the 3 ounces. And now it seems like anytime you buy just a normal size tube of toothpaste, it's always under 3 ounces unless you get the big jumbo size. So consumers are recognizing that prices have gone up, but businesses are also cutting their packaging size, and yet we're still all going to buy. And the reason that matters for the stock market is, again, if they can keep prices high, cut what they're actually putting in the package, that drives up prices of the stock market over time. Yes.
Couple of things to talk about here. I like this graph because it goes back 25 or more years, almost 30 years. And the recent 5 years looks a lot different than the rest of this graph, doesn't it? And I think it would behoove us to remember the spots that we've been before as investors, and probably during all these years, accumulators, saving and scratching together our nest egg. And so this is near and dear to my heart, all of this, because this is my time as a professional investor. I was an investor during all of this, and I remember these emotions and feelings of watching 2008, 2009, things go down 57%. It was a free fall. And I remember being in Kurt Pearson's office here because I was the son of one of Kurt's clients. And so Kurt was my advisor too. I remember being 10 years later where the dollar that I put in back here was now worth $1 again. I remember saying, Kurt, I thought this was supposed to work. And we had great conversations, and look what's happened since then. There's a lot of ink spilled about what has caused this that looks so much different than the prior 15 years. And one of the answers that comes up sometimes is money kind of got really, really cheap in here. And by cheap money, I mean very, very, very low interest rates for quite a long time. And so that has the effect of when you can't earn a good interest rate at the bank, right? You go out and look to where you can earn a good interest rate. And for a long time, that was the stock market. And in the same respect, Dan, I think you're going to cover this too, but the stock market has become what some people consider quite concentrated. And there's a lot of data on that. But I guess our point of view is they're concentrated in wonderful, fabulous companies that essentially lead the world in their area. And you might want to have a part of ownership in those companies to experience things going forward. And always the question is, right, the past is very clear, but what does the next 10 years look like, which nobody knows.
Yeah. No, I think well said. And I think one of the things that I've appreciated partnering with Compass, and hopefully you all see, is it's great to have the 90% and the straight up. But again, go straight up to the moon forever. And it's not always about getting the highest return, but it's about protecting what you've made. And I think what we're saying at JP Morgan is today is while there is optimism around growth in the future, I wouldn't suspect it to be up another 90% over the next 5 years, at least just in the US, off of the backs of just a handful of companies. There's always something that causes the market to go down. These are something that I'm not talking all about today. But again, be ready for that. It doesn't mean to go back to where it was in 2000 or 2020, but market pullbacks are normal. In fact, they happen every year. The point is, with those market pullbacks, it doesn't feel good at the time, but if you go back to 1980, the red dots show every market pullback over that time frame. The point is, every single year there's one of them. We could go year by year and point out what they are. I won't bore you with all the details, whether it's global pandemics, debt downgrades, inflation scares. Every year the market goes down. Those are the red dots. But despite those red dots, the gray bars show what the market did to finish the year. And if you look back through history, 34 out of the last 45 years, the market finishes positive. Back in April, when I was doing this same event, it wasn't as pleasant. I didn't get dinner rolls thrown at me at different restaurants, but I got some evil eyes. The point here is now, we're not down 20% anymore. We've actually recovered. And for those investors that stayed in, they've recovered all those losses and gained. And that's to Guy's point. It's the market's up a lot, but it's really been driven by just a handful of stocks. Today, when you look at the market, today, the top 10 companies represent 40% of the S&P 500. So the S&P 500, believe it or not, has a little bit more than 500 stocks, but 10 of those companies is 40% of the market. It's extremely concentrated. And again, if we flash back to where we were back in 2000, it was also very concentrated. The difference was back in 2000, those 10 companies represented only 15% of the earnings. So they represented 25% of the market, but only 15% of the earnings. Today, those 40 companies are nearly 35% of the earnings. So there's always ways to justify things, but to Guy's point, these top 10 companies, Amazon and Microsoft.
Oh, hold on, I was going to have them guess.
Okay.
Okay, you heard one, Amazon. Throw out what the other 10 or 9 are. Apple, Nvidia, not AT&T. Google, yep, that's Alphabet. Microsoft. Keep going. I already said Nvidia. Yep. Nope, not yet. They're not publicly traded yet.
That's Microsoft.
Help me out. Tesla,
Avago, Berkshire Hathaway, JP Morgan.
Hey, look at that.
NVIDIA.
JP Morgan's in there. Okay.
Meta, Facebook. Yep.
Yep.
Again, the point to that is those are great companies, but 40 years ago, 30 years ago, AT&T was a top company. They're not today. They're still a good company, but they're nowhere near the top. In fact, in the last 10 years, AT&T's stock price has kind of gone flat, where the rest of the market's gone like that. No one knows what the future of these top 10 are. In fact, they're big today and doing well, but like we saw with AI back in February, some competitor, whether they're US, a private company today, or some international company, is going at companies every single day. And I think that's why risk management, active management, and to what Compass does a lot of through diversification is paramount.
Two examples for you. OpenAI, right? That is who created and runs ChatGPT. And that is a major search competitor now to Google. Okay, so that's one example going on. However, here's another example I talk about with who owns the future. Google, years and years ago, bought a little company called Waymo. And Waymo at that point was a map company. They're mapping out streets, kind of like Google Maps, right? And they found out pretty quickly, Waymo found out pretty quickly as a subsidiary of Google that doing maps wasn't going to be the wave of the future. So they took all their data and they started working with self-driving cars. Waymo now, so they're a self-driving car company and they started in San Francisco and are now in 20 other major cities. Waymo took 7 years to get their first 10 million driverless rides. These are self-driving cars with no driver, no steering wheel. You get in and it drives you where you want to go. Okay. Took them 7 years to get to 10 million rides. Last month, they did 30 million rides. Think about that. And if you talk to somebody who was in San Francisco and took one of those self-driving rides, they say they love it. It's a little slower than the traffic. It feels safe. Accidents are 1/7 of human drivers. So it is coming, folks. And guess what? That's a search engine company that owns self-driving cars. Those are the companies that got the money and the technology to create our future. And that's why I'm such a big believer in these companies, that they're going to continue to spread into other areas of our economy and make great things happen.
Yeah, well said. And I think we're also excited at JP Morgan. Many of these companies, these high growth companies that are creating revolutionary technologies, but like everything, it's not going to be a straight up ride. While the market's been a roller coaster, the market's made up of many stable companies as well that aren't as cyclical as some of these high growth companies. Regulation's going to impact it, safety, technology, and I think due to how far they've come in such a short period of time, I would expect some point of volatility episode with those names. And I think that's where you want to be more diversified than just the top 10 names. And to that point, one area of the market that is bounced back quite nicely this year is international markets. Over the last 15 years, the US market's up 15% per year, where Europe and Japan are up about half of that. So it's definitely paid to stay invested mostly in the US and avoid outside. But if you look at what's happened so far this year, Europe's up 30%, China's up 25%, the US has had a really good year, up 10%, but pales in comparison to where international markets are. And when you look at what's making up that, it's not just a handful of stocks. There's some really good companies outside the US. These aren't just, boring companies. In fact, if you look at European aerospace and defense companies, that's the purple line. US growth that the guy was talking about is right here. Think how much higher the European the aerospace and defense stocks have done. Now, I'm not proposing to you go buying those names. It's just like when you hear an advertisement to buy gold or Bitcoin or some real estate investment. If they don't know anything about you, if they've never met you, and it's just some person talking in front of you or talking at you, don't take their advice. You want to work with someone that knows you, that knows your goals. So don't take this as investment advice. But I think the point being here is there are good companies outside the US. And one trend we're seeing with European aerospace and defense is as the US administration is nudged or forced or whatever word you want to say, does Europe more money on NATO due to what's happening with Russia and Ukraine or in the Middle East? They're doubling down on how much money they're spending on their military and equipment to protect themselves. We're seeing Taiwan, we're a benefactor of that with all the chips, with NVIDIA and the such. They've done really well. International banks. And let me just lastly say, while the US market's done well, that's the gray line over the last 3.5 years. If you take out just one stock, NVIDIA, out of the S&P 500, Japan and Europe have actually outperformed the United States markets. So two things this tells me, that's how good NVIDIA has been. All of you own NVIDIA in some form or another through a mutual fund or an ETF and your IRAs or your 401ks. The point being there is there also are good opportunities outside the US. And I think if you know where to look, you have a team that can source those ideas, there are ways to make money, but also at a lower valuation and maybe less aggressive than the higher valuation of some of the optimism around these US companies. So I think it just makes for a diversification story. The other area that I want to just to briefly touch on is the bond market, another area that we think it's critical to have diversification outside of just US stocks. Now, for the last roughly 6 years or so, interest rates were really low. But then, of course, inflation spiked and the Fed had to aggressively raise interest rates. And by pushing interest rates higher, sir, if you owned a bond yielding 2%, and today we have bonds that are paying 5%, The rest of the room can buy one of our bonds. They can buy this gentleman's 2% bond, and you can buy my 5% bond. It's issued from the same company. It's the same term, same everything. Maybe you're going to want his 2% bond. Who wants my 5% bond? Right? Point is, if you're going to sell your 2% bond, you got to sell it at a discounted price. And that's what happens when interest rates go up. 5 years ago, interest rates were very low, so all these bonds that were issued are selling at distressed prices. That's why bonds haven't made a lot of money in the last few years. The good news is moving forward, if you look at really all the various sectors from US government debt, rates are around 4. Municipals for high tax rate individuals, you're nearing 7%. That's long-term equity, nearly long-term equity returns from the safety and the stability of municipal bonds. Investment grade corporates north of 5. These are some of the best incomes we've seen 15 years out of fixed income. And while there's always risk if rates go up, they of course could go down. But the good news is with US stocks at all-time highs, for the first time, we're seeing high quality bonds actually act as a diversifier. Now, again, I mentioned if rates go back up, maybe due to inflation or fears around government debt, I wouldn't want to have all my eggs in just bonds alone. But as a part of the overall portfolio, whether it's some short-term bonds, some intermediate-term bonds, having some bonds, just the income, as we approach retirement or in retirement, it's a healthy source of income. And you couldn't say that 5 years ago when you were getting 0.5% from government bonds. So I'm going to pause, but let me just wrap up with one last slide. And then I'd love to take maybe any questions from those of you that are in the room or those of you that are on the line. All right. Time, diversification, and the volatility returns. How many of you have been in a meeting in person or online with the Compass team and you've heard them say, you're diversified? You've heard them say diversification. Yeah, a lot of nods, shaking. Absolutely. They say it probably every meeting. Now imagine if you gave them $100,000 today and 1 year later they put you in this gray line, which is a pretty diversified portfolio of about 60 stocks, 40 bonds. You give them $100,000, 1 year later, the worst 1 year period for that portfolio was down 20%, which means your 100,000 went to 80,000. How many of you would be happy that you were diversified? Probably not real happy, right? Now that's for the diversified 60-40. Bonds have lost money as well. Stocks have lost even more, but this is basically the range of outcomes over a 1 year period, the worst and the best. The point is, I mentioned at the beginning, I have no crystal ball. I don't know where the market's going in the short run. But if you have time on your side, and chances are, if you're getting asked by Compass to take some money off the sidelines and put it to work, they know you have that time. You don't need it in the next 6 months or 12 months because they've done that planning work with you. While we'd love you to have 20 and 30-year time horizons, all I'm asking for is 5. Take a look at this 5-year rolling. This goes back to 1950, and it shows the best 5-year period for a 60-40 and the worst 5-year period for a 60-40. What that's saying is if you don't need the money for 5 years, worst that 60-40 portfolio ever done per year over a 5-year period is positive 1% per year, and the average is around 9. Well, there's no guarantees that's going to repeat itself. Chances are, if you don't need that money, now is a good time to be putting money to work in a diversified portfolio of some US stocks that look attractive, but are frankly high. Be some international, some fixed income, and a mix of all the above. Have time on your side and you don't panic and stay the course. Most importantly, stick to the plan that the Compass team has put in place. I think this shows that you're going to have success over the long term. So I'll pause there. I'd love to take any more questions you have around topics that I covered or things that you've read about or on your mind that I can do my best to have Guy or myself answer.
Yeah, I'm going to start with one that I think is on a lot of people's mind. Tariffs and inflation. You talk about those two things?
Absolutely. So as we're getting to the slide here, feel free to kind of be thinking about any questions you might have. I know we got a little bit of time here, so we'll get to the tariff slide. Okay, so the gray bars are showing the rate of tariffs for imported goods for the US going back to 1900. And so here we have kind of the Smoot-Hawley era of the early 1900s. This was basically after WTO was created, kind of saying global trade is a good thing that helps everybody. And while we still believe that's the truth, there's absolutely some side effects of pushing manufacturing and labor to lower producing countries. And for most of the last 20 years, we've had tariff rates to near zero, 2 to 3%. A little bit of an increase during the first Trump administration, those stuck during Biden, but around 5% coming into this year. Fast forward to Liberation Day, April 2nd, April 9th, the average rate of a tariff produced outside the US and brought in was around 30%. And I think that's what spooked the markets. It's not that they don't like any tariffs, but it was just much greater than expected. And typically the market overreacts. And again, since then, the rate has come down. We estimate, and we update this every day. This is actually as of August 12th. It's changing literally by the day, but we estimate the average rate of tariffs around 17% today, which is significantly higher than what we've seen. Yes, sir.
Would there be any correlation between that and the trade deficits?
There absolutely is. Yes, yeah, absolutely. And that's why we had a negative first quarter growth, because companies brought even more stuff in that pushed our GDP down, our trade deficit up, but it absolutely does. And so over the last 25 years, that's why our trade deficit has gone up so much. That's why our dollar has gone up. As when companies give us stuff, they have to, in turn, they give us a widget, we give them dollars, and that pushes our dollar higher. And that's good in some ways, but not in every factor. I guess the point I would make, we could spend all day talking about tariffs, but the point I would make is thus far as it relates to the stock market, again, we could talk about labor, immigration, a lot of factors here, but as it relates to the stock market, so far, most companies and most importers are absorbing this cost. They haven't yet passed it on to the consumer. And so we'll see where this plays out and eventually how long it lasts, what businesses do, but it's going to be a mix of some importers eating that cost, some of the companies, whether US or global, taking on that cost. So that means potentially lower earnings or maybe a hit to their stock price. But ultimately, some of it is going to get passed on to all of us, which means slightly higher prices. I think the effect of the economy and what that does to inflation is, in our view, kind of a one-time hit to prices. So prices will go up. We don't know exactly how much, but one time. It's not that it's going to keep going up at that amount over the course of history. And that's why I think the market is still believing that even if inflation may take up a little bit towards the end of this year due to tariffs, the Federal Reserve is still on track to start lowering interest rates due to the economy slowing and unemployment starting to tick up. So it's absolutely having an impact, but I think don't overreact to this news, because whether it was mandating healthcare, 10 or 15 years ago, whether it's putting how many calories are on a Big Mac up on the board when you go to order it, or limiting how much you can buy in certain things, companies always figure out a way to adapt and survive and to continue to grow. And so that's why I think it's really, really important not to overreact to this and just kind of take a deep breath and maybe, not do anything at all is sometimes the best core of action. Yes, sir.
Okay, hold on.
Okay.
Because of the people online, we need to get you the questions mic'd here.
To your point about tariffs, don't the markets generally like a level of certainty? And isn't there a lot more uncertainty in the market, but we're still going up?
Yeah, and I think that's why back in April, when we knew tariffs were coming, Trump ran on tariffs. But what he didn't run on is what they called the reciprocal tariffs. And frankly, the calculation they put out, even if we didn't like it, it just was wrong the way they calculated. And it was much higher than expected. And that's why we saw that huge sell-off, because of that uncertainty. Since then, they've kind of backtracked, said we're going to negotiate some of this. Some of it's going to stay in place. But again, I think some of this is yet to be determined, and I think that's why I had a little bit of caution. While it's great to see the market at all-time highs, things could shift relatively quickly, and that could also change the path of the stock market.
There was an item on the news last night that the national debt hit $37 trillion, 5 years ahead of what it was projected
Yep.
to hit that level. So given that we just extended tax cuts that are supposed to put another 3 or 4 trillion onto the national debt, and given that Social Security is expected to hit a cutting level in 7 or 8 years, I guess, what policy choices do you think the folks in Washington have, given the debt levels, given some of these big kind of cliff events in safety net programs? You know, what can they do to kind of make sure that the folks in this room aren't like on the street looking for our Social Security checks?
It's a great question. It really is. Let me pull up a slide here to kind of show you some facts to what exactly you said. It's the other way. Okay, so federal finances. So I think your question around the debt hitting 37 trillion. When I out of Des Moines on Saturday, they've got the billboard. I think it said again, $108,000 per person. I think trillions. I don't even know how many zeros are in a trillion, but it's a lot. But 108,000 for every single one of man, woman, and child in America. That makes it real. As far as what policies they could do, I think there's a lot of policies they could do. I'm not a senator or policy maker, but the fact is, without turning this into a political caucus, I don't think either side of Washington, whether it's Republican or Democrat, want to do it. And whether that's cutting some spending in certain programs, whether that's raising some taxes for some of us in the room that have the means, maybe increasing the amount of tax on Social Security as we make it, and potentially just finding ways to grow the economy. I think that's at least what we know today of the path the U.S. Treasury President talked about is through tools like deregulation and AI and just getting America back to more of a normal growth, 2%, 3%, 4% growth. Care of some of it as we would grow our economy, not necessarily cut the debt, but the economy would grow faster and make the debt to growth at a lower level. But I think all of those policies, at least today, no one's really talking about doing those things. And so to that point, I want to set kind of where we're at and just show you today, we've got $37 trillion in debt. If you take out the money that Social Security is borrowed from, the Treasury is borrowed from Social Security, we basically have the same amount of debt relative to the same amount of our economy's size. And over the next 10 years, with the One Big Beautiful Bill, that's expected to go from around 100% to around 120% over the next 10 years. And so the debt's expected to continue to grow, and that's with a lot of these policies that are in place today. And while that is absolutely concerning, I think our biggest concern is we're still spending, even in a Republican administration, we're still spending like we're in a deep recession. So these vertical spikes are the 2008 recession, the COVID recession, but normally after the recession, spending comes down. This time around, we didn't see that. And our biggest fear is we have a high debt. Other countries are kind of, but what happens inevitably when the next downturn happens and the US has to kind of throw out some stimulus to consumers or help certain sectors of the economy? What does that do to our national debt? And eventually that just crowds out money for roads and schools and senior Social Security. There's only so much that can go on. But I think taking the glass half full approach, if I could, while we have a huge debt problem in the United States, I also think it's important to work at the asset side of things as well. Just like when Compass is meeting with you, they look at not just your 401k and your IRA, but they look at your mortgage. They look at your credit card debt. They look at everything. The U.S. has $37 trillion in debt, but it's estimated the U.S. has $400 trillion in assets. If we put that in perspective, that would be like you having $1 million in your 401k and going to Compass to say, hey, I'd like to buy $100,000 investment property and take a mortgage on it. $100,000 in debt, 10x that in assets. Now, I'm not going to say if that investment property is good or bad. I mean, do you want to be a landlord in retirement? Is that a good investment? Is it a good location? But is it a debt problem when you have 10 times the amount of assets as you do debt? I would say not necessarily. So the US government with $37 trillion in debt, it's big and it's going to get worse. But if you look at the asset side of what the US has, it's 10x that. And what are those assets? It's $100 bills. It's gold bars. It's Yellowstone National Park. It's Interstate 80. It's oil reserves. And if the US was so in the inclination that they couldn't pay those bills, whether it's to seniors or to foreign governments, maybe they would come up with a plan to, sell Interstate 80 to a group of investors. And we all could turn it into a toll road and they could get that money today. Not saying that's going to happen. I drove through Indiana with my camper in July. One toll was $90. So, and it was construction one lane the whole way. So I don't think there's a lot of value for that $90. I hope the US doesn't get to that point and we can make some big, hard decisions today. But we'll see if that actually happens.
Dan, I have a little bit to say about that.
Yeah.
The debt is really kind of how Dan framed it. It's not really a debt problem. It's a payment problem because we owe interest on all that debt. And so the real question always has been, can we afford to pay the interest on all that debt? And the answer is still it's tough to say here because here's your expenses of the federal government and here's your income. And there's that deficit right there. And that is we are borrowing to make up our income deficit. So again, can we, on an ongoing basis, pay the debt on that? And the answer is there's more question about that today than there has been in a long time. And frankly, as a taxpayer, I'm happy to see that discussion happening. But hey, this is becoming a problem. We're paying more and more. We pay almost $1 trillion in interest on our debt every year. And it's becoming a larger and larger part of our budget. So I think there's a lot of work to do in the future. I think there will be some grumbling. I think there probably has to be some tax increases going on, but it will eventually get to a point where we will need to make some changes to be able to afford our debt. And the other thing that's going to happen with debt is the interest rates are going to go up because the people that are buying our bonds that the government's selling to fill in this deficit, they're going to demand higher interest rates, right? So that's one of the dangers out there of having a big debt is it can push interest rates up.
Well said. Any other questions from those that are in the room or online?
Questions? We got one in the back here.
We could always bring Steve up to talk more about the national debt if you'd like.
Steve, keep your soapbox over there. But no, kind of along the lines of debt, question for you, Dan, is something that does help us with our debt is the fact that we are still the world's currency, right? But of course, there's been talk and push in some ways to devalue our currency, whether it's other countries that would prefer we use their currency for trading purposes, like Dan was saying earlier.
Yep.
Or also think about like cryptocurrency and just other alternative types of currency, right? Or alternative types of trade. What's JP Morgan's view on how currency and the importance of the US dollar factors into when we talk about debt with all these other kind of competing interests coming online?
Yeah, so I don't mean to be flippant about it, but we don't see a competing interest today. That doesn't mean it can't change in 5 years or 10 years. But 10 years ago, people talked about the euro being the competing interest to the US dollar. And about 12 years ago, or I should say 8 or 9 years ago, 2012, it's 13 years ago, the euro was about to fall apart. For a while, people talked about cryptocurrency replacing, and they're still talking about that today. But if you notice, they often drop the currency part of crypto because it's too volatile to be an actual currency. If you think you have $100 today, tomorrow you have 120, the next year you have 80. That is not a valid means of currency exchange when it's that volatile. It doesn't mean it's not going to happen down the road, because today we're seeing foreign countries, adversaries of ours, as we've sanctioned them, they're saying, wait a minute, we don't want dollars in US dollars, because if we're going to sanction Iran and they have US dollars, they can't spend it. And so they're diversifying to other forms to protect their own interest, which, I mean, kind of makes sense, right? But I think what the US has that most other countries don't have are the best companies in the world. And I just wanted to show this one chart on AI, and I know it's not directly related to your question, but I think there's always that fear out there of what's going to happen. If you take the top four, what the industry calls hyperscalers, these are not just the AI companies. These are the biggest companies that are spending the most on AI. One example of them is a West Des Moines company, Microsoft. ChatGPT, when you use that, whether you're in the US or around the world, it's all done out of West Des Moines. They're the biggest user of water in Polk County to cool all those data centers that they have off of 35 and the highway down south. But 10 years ago, they were spending about $40 billion on AI, on technology like computer chips and servers. Today, they're spending $400 billion on, or excuse me, $400 billion. So it's 10x in 10 years. And again, that's all money that's going into US companies. And I think whether it's good demographics here in the US that we're still growing slightly, whether it's good companies, I think capital goes to those that treat it, whether that's a country being mindful of the debt or good companies receiving capital. I think as long as we can have good policies, good companies, I think a lot of this stuff is going to work itself out, and it has over time.
I'll add to that. By the way, these slides are all available online. This is the JP Morgan Guide to the Markets. And so you can go Google that, AI search it, whatever, and pull these up, and all hundreds and hundreds of slides with really great information. To second what Dan said, just the exceptionalism of America is number one, that we have by and large free markets. And that number two, we have by and large functioning democracy. And that is not true all over the world. And so we are not operating in a vacuum. We have been the best for a long time and continue to be the best in relation to all the other places in the world. You know, we talked about Europe. It's really struggled with growth. It's struggled politically. It's struggled with their euro. China, I don't know that anybody can trust the data that comes out of China, right? Russia is a mess. I've done a lot of reading about their war with Ukraine and how if they didn't do it now, they wouldn't have able-bodied people. Their demographics is very poor. Not very many young people in Russia. So 10, 15, 25 years into the future, that country's in trouble unless something changes. So there's a lot of stuff going on. We have to be the best house on the block, and we continue to be so, is what I'm trying to say. All right, I think we're done. Dan, thank you for your time. Everyone that joined us today, thank you very much for coming. Thank you for your trust. Thank you for being clients. Thank you for sending your referrals. That's how we continue to grow here at Compass. Make sure to come next month. Our next event is navigating the long-term care and facility choice and the end of life healthcare decisions. So it's always the second Thursday of the month. That's when we try to put these on. So look for an email. We'll be sending emails out as an invite to that event. So have a great day. Thanks for coming.